Hi, this is Mark with Right Line Trading, and what I would like to discuss with you today is pivots. It's something that a lot of traders take for granted, and in fact, as I've noticed of late, it's something that a lot of traders don't use. And I'd like to show you why that's a fundamental mistake, and exactly how pivots work. First of all pivot indicators work a little bit differently. And at Right Line, we really do have a unique pivot indicator. And I want to show you the pivot indicator that comes with the NinjaTrader platform. You can see here on the right edge. You can see that in no way does it provide you with particularly accurate areas of support and resistance here. I mean, price seems to move quite independently of it. And here's the thing that I think is extremely important that a pivot indicator must define clearly. What creates a pivot? Now, a pivot itself is simply a turn in market price. We see that price goes up and then turns to the downside. And then this creates a large pivot. Now, in essence, every single move down, move up, move down, move up, each one of these moves creates a pivot. The issue is, what is this number of candles that must be involved to create a pivot that's relevant? And that is really a critical analysis that is rarely done. What we've done at Right Line is we've done 2 years of market replay data to determine, now I'm going to remove the Ninja indicator, the optimum sensitivity for our indicator that creates relevant pivots without creating a significant number of irrelevant pivots. In other words, it's the best middle between being overly sensitive, in which case you're going to get lots and lots of pivots, of which only few are relevant, and being overly specific, in which case you're going to get only very major pivots and lose the intermediate pivots, which are of relevance to trading. In addition, a pivot, by definition, and this is Japanese candlestick dogma, is created from the top of a candle body. That creates a pivot. And that's extremely important. And you can see how precise that is on this retest. It's the candle body that creates the pivot. Now, what happens in a pivot? A pivot turns when, on a move up, an overabundance of sellers waiting at this price turn the market down. Now, we know that when price comes back to retest the first time, it's likely going to fail. When it comes to retest the second time, and price here is only a few ticks off, it's also likely to fail. Now, unlike certain areas of support and resistance, pivots weaken each time they're hit. Now, there's an overabundance of sellers here, but each time those sellers repel buyers and push price back to the downside, some of those sellers get expended in the process. So the pivot begins to weaken. Certain trend lines, those of market profile, a 50-day simple moving average, things like that, they don't weaken. They maintain their stability throughout the course of a move, but not a pivot. That makes it a unique area of support and resistance. Now, since it's been hit twice and turned the market, dogma states that the third time that that pivot is tested, it's likely to break. And you can see that's exactly what happens here. Third test, it goes right through. Now, when is a pivot considered to be broken? And again, we have to go back to Japanese candlestick methodology. When are we sure that all the sellers present in this line have been firmly overwhelmed and this pivot no longer acts as a resistance barrier to upside price movement? Well, the answer is this. When two-thirds of the candle, when a candle body penetrates the pivot with two-thirds of its candle body, that's when the pivot is considered broken. So this candle right here does not break the pivot. But this candle body, even though it's small, closes in its entirety over the pivot, and the pivot breaks. You can see at the close of this candle, the pivot stops tracing. Now, our pivots adhere strictly to candlestick theology, so to speak. This is the way the Japanese intended pivots to work. And they become a very relevant part of trading if they are utilized appropriately. Let's take a look at this low pivot. The market comes down, creates the pivot, comes up, it's tested once, comes up, it's tested twice, comes up, and it's tested a third time. In this case, the pivot holds and sends the market right back up. So you can see how relevant the pivot is once it's created. It becomes a functional part of the chart anatomy. Now the pivot is created here and is present when this candle comes down, this trend comes down, and this small retracement comes down to hit. The pivot rejects all attempts to break it and rejects price, and the buyers there swarm and push the market right back up. Here, look how taking a trade into this pivot would have ultimately caused you to take a major loss or a number of major losers. This is why it's very difficult to anticipate a pivot break. Now remember, each time the pivot is hit, it does weaken. And in general principles, the third time a pivot is hit, it may be weak enough to break. But in our trading methodology, we don't anticipate that a pivot is ever going to break except under the following circumstances. And remember, day trading is all about controlling risk. You want to take the most conservative trades you can and the ones that are not associated with risk. Trading into a pivot simply increases the risk that the trade will fail, or increase the probability that the trade will fail. And you can see right here, the pivot's created right at the candle body high. Price comes right back up, rejected, comes down, goes all the way up within 4 or 5 ticks, and rejected, and eventually sends price all the way back. Now, when can we make the assumption or anticipate the break of a pivot? Like I said, in circumstances when the pivot is challenged for the 3rd time. But there's one circumstance where we have found that pivots can be anticipated to break. And I'm going to show you that circumstance. And I'm going to use one of our other indicators to make it easy to find. It's called our consolidation indicator. Now, consolidation is a very, very powerful formation. And I'm going to show you exactly what it comprises. I don't want this video to go too long, but I think this is an important part of trading pivots. Now, consolidation, you think, would be easy to see. The fact is, it is not so easy to see. And our software defines it very, very meticulously, and it's areas of well-defined consolidation. Now, consolidation is an area. This is a good example of consolidation. Now, this is a little bit more broad-based, comprising smaller multiple channels of consolidation. It's where the power of the bulls and the power of the bears is equal. And you can see it traps buyers, sellers, buyers, sellers, and so forth, all in opposite directions. So when it breaks out of consolidation, it's going to break out with huge power. The reason being that all of the traders trapped in the counter trend direction are going to get stopped out. They have to buy back their contracts to cover their position. That pushes the trade up. In addition, new buyers move into the trade. So this moves up with a lot of force. You can see that once it breaks out of consolidation, it eventually makes it all the way to here. And ultimately, all the way to here. Now, you would have to have quite an ATM strategy to capture this whole move. But you can see how powerful a breakout of consolidation is. Now, an entry out of consolidation into a pivot will commonly break that pivot. Now, whether or not you want to trade into a pivot at all is up to you. But if you're going to trade out of a pivot, into a pivot, you want to trade out of a consolidation signal. And I'm trying to find a good example for us. Where we get a signal right into an intact pivot and see if the pivot gets broken. Sorry, I have you on a kaleidoscope here. But anytime I try to look for something to set up, I can't find it. You can see all these great consolidation entries. What I'm going to do is quickly move to the E-mini. You get a lot more pivots on the E-mini. And we're going to take a look at trading signal into pivots. and on the low 15 days. Okay. Here's an example right here. Finally found one. Here's an entry out of consolidation. That green dot is an entry signal that occurs intra-candle. Allows you to place your entry one tick above the close of the candle on an anticipation of a break of the pivot out of this area of consolidation. Now, this is the narrow consolidation channel. And this is the more broad-based consolidation channel here. And these are all potential entries. And you can see that the low of the move here is going to keep the trade intact. If you enter here, it's going to snap the pivot right through on this trade out of consolidation. If you enter it here, same thing. You're going to enter a little bit earlier, and when you're on the right edge, you don't know that you're going to get another opportunity, so you're probably going to enter here, but you'll move right through the pivot. Same thing here. Another opportunity to enter. You can enter here or here. Doesn't matter. This does not stop the trade out, and you can see that the trade just blows through the pivot. So consolidation is a very, very powerful entry signal when you have upside resistance or downside support to break, and that is in the form of a pivot. We know this is really the second test. This wick is moved through right here, but price is rejected to the downside. There's the first test. This is really the second test. And it just moves right through. So respecting pivots and having them on your chart are extremely important. If you're just trading a weak entry, you're going to wind up taking a lot of losers. Here's a pivot. Price comes up. First test, rejected. Price comes up a second time. No 2/3 candle break, rejected. We could say rejected to here. Now here, price comes up a third time, is rejected. Price comes up a fourth time. Price is about 3 ticks off. It's not far. And this pivot's an area. It's not a discrete line. And you can see down we go. And then finally, we get a break of the pivot. So the next time that price level is hit, price moves through it quite easily. This is a very small pivot. And this is one I would take less notice of. The very, very large pivots have to be treated with a lot of respect. And the one thing that I do, just as a final tip, is when I see a really large pivot, let me give you an example. Let's say we're here, and I don't know where this pivot begins because I can't see the end. What I do is I squeeze the chart, see where it started, and look how many times it's been tested. 1 time, 2 times, 3 times, and then I open up the chart and know that if I get an entry signal into the pivot, since it has been tested so many times, it's very likely to break. The icing on the cake is that the entry signal is a consolidation signal. And here's how you look at this pattern. This is a rising channel. In this channel, you have higher lows and higher highs. And so the break out of this channel at a broad-based consolidation gives you a tremendous trade on the E-mini. This is what we do in the trading room every day, and what I teach in trading school, and as part of being in the trading room, this is part of the didactic sessions we have every Wednesday afternoon, right after trading. Today we had one that lasted 2.5 hours. So listen, everyone, I wish you the best of luck and hope to see you in the trading room. Take care.